Okay, thank you and welcome everyone. Welcome back to our Options Education webinar series. My name is Tony Zhang. I am the Chief Strategist here at OptionsPlay, and today we're going to be talking about one of my favorite topics, technical analysis, and how to leverage that for your options trading. This is a very popular topic because many options traders use some form of technical analysis in their trading. So today what I really want to cover is the different types of technical analysis that we use. I want to cover this more on a broad basis, covering different tracks of technical analysis that is traditionally used with options traders. And what I really want to focus on is the types of option strategies that are useful for each form of technical analysis. There's lots of different ways you can use your charts. You know, I myself, I've been a market strategist in this market for about 13 years, starting in the FX space. I spent a lot of time looking at charts in the FX space, so I'm very familiar with all different types of ways to look at your charts. So today what I want to take is some of the broad ways that we typically analyze our charts and show you what are the best option strategies to deploy for each one of these different categories. Now, technical analysis may not be what everyone here uses. So what I really want to do is get a feel for how many people in this room currently use technical analysis in your trading. If you use technical analysis in any form of your trading, please type yes into the chat window. And if technical analysis is new to you, or if you've never used charting before, please type no, just so I get a feel for who's in the room. And you can use the chat window to respond. Okay, so I got mostly yeses. I have one new person who's new to technical analysis, and that's okay. You know, I'll cover some of the basics for those of you that are newer to this type of strategy. So today, like I said, what I'll do is I'll cover the introduction to technical analysis, what it is, why you should consider using it. I'll cover very briefly, before I get into the different forms of technical analysis, I'll talk a little bit about what are the general option strategies that are useful if you're a technical analyst. Then we'll cover things like the different forms of technical analysis. Like I said, there's no way that I'll be able to cover all the different forms of technical analysis, simply because there are literally infinite number of ways you can analyze your charts. But what I'm going to cover is the broad categories. Number one, chart analysis and patterns. This is for those that like to read the price action on the charts. Then I'll talk about chart overlays. These are things like moving averages and Bollinger Bands, the overlays that overlay the price chart to help you determine where price is going to go. Next, I'll cover the chart indicators. A very, very popular segment of technical analysis is using indicators like MACD, RSI, stochastics, these types of indicators that tell you overbought or oversold conditions. And lastly, we'll talk a little bit about market analysis and intermarket analysis, which is also a popular topic, especially for those of you that have read some of the classic textbooks on technical analysis. And then lastly, what I really want to show you guys is how you can leverage whatever technical analysis that you use with OptionsPlay that's available to you free of charge at TMX, how you can utilize this free tool that's available to you to leverage these different types of technical analysis into actual option strategies that you can deploy to potentially profit from your technical analysis. And that's really the most important piece. So today, what I really want to make sure that you learn is what type of option strategies are suitable for each form of technical analysis, and then more importantly, how to actually analyze option strategies for your form of technical analysis using the free tools that's available to you through OptionsPlay. Okay, so this webinar is recorded, so for those of you that are brand new, if you feel that you haven't learned everything right on the first try, that's okay. We'll send you the recording. We'll send that out about 30 minutes after we finish here today. I will have about a 15-minute Q&A at the very end, so for any questions you'll be able to answer, we'll be able to ask. You'll be able to ask that at the very end, and I'll answer as many questions as I have for. And the slides that I'm putting in today will be available to you with the replay of the webinar. So if you want to make sure you want to look at these slides, you'll be able to download them after we're done in the email that we'll send you. So hopefully that'll cover everything in terms of housekeeping. Let's go ahead and get started here. Let's first start off with what is technical analysis. It's really straightforward. It's really forecasting the future price based on historical past chart movements, okay? So technical analysts are, it's an interesting breed because typically technical analysts tend to be fairly analytical when it comes to how they approach the markets. Charting is certainly a very subjective thing. It's not objective at all. So every single person, two people looking at the same chart may have very different opinions as to where they think the stock's going to, where the stock is going to go. But the concept of technical analysis is very simple. It's typically looking at historical chart movements or historical chart history and anticipating what is quote unquote likely going to happen in the future. What I mean by that is that no form of analysis will ever tell you definitively what's going to happen. It's all about what is more likely going to happen or what is more probable. And this is really just saying that historically, when we see certain things, what is the probability of the stock moving higher or moving lower? And that's really what we're utilizing that theory to apply to where we think the stock is likely going to trade in the future. The great thing about technical analysis, and one of the reasons why I've consistently use technical analysis, even though I've changed asset classes in the markets that I've covered in my career, is that it's applicable to all tradable instruments. What I mean by that is if you learn how to read a chart, you can read a chart on currencies, you can read a chart on commodities, on stocks, on bonds, on futures, all different asset classes. Once you learn how to read a chart, it doesn't matter what the underlying asset is. And it allows you to take this form of analysis and apply it to any different market. And that's one of the things that I love about technical analysis. You can't do the same thing if you're a fundamental analyst. So if you're a fundamental analyst covering equities, that skill set isn't really applicable if you're trying to trade bonds or commodities or any other market. And that's really one of the key tenets of why technical analysis is really useful for intermarket analysis and really understanding not just one market, but all markets consistently across the board. The one key tenet of technical analysis is that what is more important than why? Meaning we're more interested in what happens after something happens as opposed to why something happened. And this is really because we believe that markets are efficient and price reflects everything. If any of you have ever noticed when a news announcement comes out or something that affects the market comes out, price action reacts almost instantaneously to that event. What that means is that understanding why doesn't really help you. What you want to focus on is what actually happened from that event and what is going to happen based on that reaction from the markets. And this is really the idea that price discounts all information. So trying to analyze the information or trying to analyze why something happened, usually by the time you figure that out, it's usually way too late. And that's why technical analysts don't really care why. We really just focus on the what, meaning how did the markets react and what can we do with that information. Lastly, one of the key beliefs of technical analysis is that markets are not random, that markets do follow some kind of pattern. Those patterns may not repeat itself, but they certainly rhyme. That's really one of the major influences of technical analysis in order to utilize this for your form of trading. So that's just a kind of a brief history and an understanding of kind of what a technical analyst believes in and sees. And now, so let's actually start taking a look at, what are some option strategies you can trade. Now, one of the key points of any form of analysis, whether you're trading technical analysis, fundamental analysis, or even some more esoteric strategies like, astrology. I've seen all different, I've worked with clients for the last 13 years. I've seen some pretty crazy forms of analysis out there. The one key thing is that no matter what form of analysis you do, you don't have a crystal ball, which means that you can do everything you can to shift the probabilities in your favor, but nothing's ever 100%, meaning there's always a possibility that your analysis is wrong. So one of the reasons that I have focused my trading into options with my technical analysis is simply because options really allow me to take a directional view with my technical analysis, but use it by limiting my risk. Because when you trade options, you can limit your risk because when you buy a call or a put, or if you buy some type of spread, your risk is completely limited no matter where the stock or asset goes against you. And the great thing about options is that it really allows you to define that risk and reward before you get into a trade. That's not something you can do if you're just buying a stock or a future or a bond. You're exposed on both sides as to what your potential risks and rewards are. And that's really one of the reasons why I like trading options. And I hope to show you the strategies that you can utilize with your technical analysis, or even if you use other forms of analysis. I hope that you can see how options can be beneficial from this perspective of helping you limit your risk, which is really the key thing to success with trading, regardless of what form of analysis or what market you trade, is limiting your risk. So what I've broken down this into is two sections. And the reason for this is because depending on the form of technical analysis you're using, there's generally two different forms of analysis. One form of analysis where you have a clear entry price, but you have an unclear exit price. What that means is that you get a clear buy signal or sell signal, but as to when that buy signal or sell signal is completed, you're unsure. There's different forms of technical analysis that provide you with a buy signal, but you don't have a clear exit price or exit signal. And for these types of strategies, the two different type of option strategies that you want to deploy is simply buying a call or a put. So meaning a strategy that allows you to take unlimited upside or unlimited downside on an individual stock. This allows you to, and this is a strategy that you would utilize when you expect a quick and fast move in the underlying stock or ETF. The second type of strategy that you can deploy when you have a clear entry price but an unclear exit price is credit spreads. But this is more useful for when you expect a neutral or small directional move. So if you think that the stock is going to move a little bit higher, but not a significant move, but you do think that there's going to be a small move in one direction, you're better off trading credit spreads in that specific scenario. Okay, so if you have a clear entry price and unclear exit price, the two different strategies you can take is a long call or a put when you expect a big move, or selling a credit spread when you expect a small or modest move. The second form of technical analysis that you'll see that we'll go over here today is when you have a clear entry price and a clear exit price. There's different forms of analysis that kind of provide you with these type of exact entry and exit prices. And for those types of strategies, it's usually best to utilize debit spreads. This is when you usually expect a modest directional move in one direction or another, and you have a clear exit price. Debit spreads allow you to really maximize the profit of a trade by when you have a clear entry and exit price. So now that once we've had these three different strategies covered, let's start taking a look at some different forms of technical analysis and seeing why each one or which strategies are most suitable for different forms of analysis. So first, I'm going to start off with chart analysis. This is the most basic form of technical analysis. This is simply just reading a chart. There's no fancy indicators that we're adding to this. There's nothing really to learn other than just learning how to read the chart. So this is usually, when I talk about chart analysis, these are things like reading support and resistance lines and drawing trend lines. These are the most basic fundamental pieces of technical analysis. So these types of support and resistance levels, as you can see, here's a stock trading between around $42, $43, and $33. So as you can see, this green line down here is what we consider support, because as the stock hits these levels, it bounces higher. When it hits this red line, which is resistance, when it hits it, it bounces lower. So support is when it bounces higher, resistance when it bounces lower. So as you can see, as it consistently moves between these two levels, we can, once we've established this first support and first resistance level, this is a potential entry buy signal. This is an entry potential sell signal. This is a potential buy signal. Here's a potential sell signal. And each one of these provides a clear entry on the buy line where the green line is, and a clear exit where the red line is. So for these types of strategies, it's usually best to use debit spreads, but you can potentially use credit spreads too as well. So if you expect that the stock is going to bounce off this 33 level and shoot all the way back up to 43, you want to use a debit spread because it allows you to really maximize that return of that stock from 33 to 42. If you think that the stock is just going to bounce off 33, but you don't think it's going to go back all the way up to 42, that's when you can consider using a credit spread. because that allows you to profit as long as the stock stays above $33. So support and resistance and trend lines can be used in different ways. You can either think that the stock's going to bounce higher and move all the way to the next resistance level, or you can simply say that I think that it won't go any lower than 33. But depending on which one of those two you believe in, you should use a debit spread if you think the market's really going to rally to that next level, or you can use a credit spread if you simply think the market's not going to go any further lower than a specific level. So those are two different ways that you can utilize options when you're drawing simple support and resistance and trend lines. So before I move on, I just want to do a quick kind of check again. How many people here are familiar with the concept of support and resistance levels? If you are familiar with support and resistances, please type yes into the chat window. Okay, great. So everyone here is familiar with the concept of support and resistance. Great. So I hope that what I just explained in terms of using debit and credit spreads was clear to everyone. So let's move on. Let's take a look at a different form of technical analysis. Also a fairly simple and easier one to read is breakouts and breakdowns. This is really where you see stocks kind of break down or break out from a specific range. And this is usually defined as a stock trading within a sideways for a period of time and then moving significantly in one direction or another. So here's an example of a breakdown where the stock was trading within a fairly tight range for quite a few months and then broke significantly lower. Same thing here, traded within a fairly tight range for quite a few months and then eventually broke higher. So this is what we consider breakdowns and breakouts. Now, this type of analysis, typically what we have is a very clear entry. However, they typically have unclear exit signals, meaning there's really no target that these types of things provide, right? So when this stock breaks down, there's no real indication of how far down it's going to go. Conversely, if it breaks higher, there's no indication as to how far higher it's going to go. So these are the different analysis that you can do on a chart. So because of the fact that you have a clear entry, but you don't really have a target price, buying calls and puts is usually a more suitable strategy for these types of trades. And breakdowns and breakouts typically move very fast. As you can see, this happens over a very short period of time, just a 1 week move or 2 weeks between when it moved to 60 before it moved all the way down to 44. So about a 25% move in the matter of 2 weeks. This is where calls and puts really allow you to leverage these types of trades to take full advantage of a big move over a very short period of time. Same thing here on the breakout. Once that stock broke out, it only took about 3 weeks for it to move from about 45 or so all the way up to 55. So about, again, a 20% move over the course of 2-3 weeks. Buying a call here would have been the best strategy to utilize when you expect the stock to either break out or break down. Okay, so is that clear to everyone? If it was, just type yes into the chat window so that I can move on to the next slide. If there's any questions, please, I'll leave them in for the end. But it looks like everyone seems to be pretty clear on kind of breakouts and breakdowns and using calls and puts for these types of strategies. Here's just another example here. We call them breakaway gaps. So this is, again, same thing. The stock kind of trades sideways for a period of time and then starts to break away. Now, when we talk about breakaway gaps, these are simply saying that stocks that typically break out for above a certain range, they tend to have quite a bit of follow through, as you can see here. So when the market gaps above a specific range, we typically see quite a bit of follow through. And again, this is very common where you have a clear entry price right on that gap higher, but as far as where it's going to go, it's kind of unclear. There's really isn't a good way to determine a target. Some technical analysts will take the size of the move entering the consolidation triangle to try to measure out how far of a gap higher. But again, that's a fairly inexact science. So again, the best strategy to use in these types of examples is just simply buying a call or a put, because it allows you to take advantage of a quick move in one direction and you don't have a specific target price in mind, so you really want to just hang on to this for a while and see where it'll go. So buying calls and puts usually is the better strategy to use for these types of trades. Second form of technical analysis that I think is very, very popular is chart patterns. And there are so many different chart patterns, I can't even begin to list them all, but I'm going to talk about some of the major ones, the ones that are easier to spot. Things like double tops, double bottoms, head and shoulders. These are the ones that people are typically most familiar with. Double tops, triple tops, these types of formations, if you will, people generally understand. And this also follows the same thing as breakaways, is that you have a clear entry but an unclear exit. So, for example, here I have a double top where the stock, hits 60, hits 60 again, and then hits 60 again. This is almost like a triple top. And there's two ways that you can read this. Either you think that this is a triple top and it's going to move back down to its support level, which is where we saw here around the 53 level. Or another way to look at double tops is that you simply don't think it's going to go further above 60. So depending on whichever one you believe in, if you believe that the stock's going to hit that top and fall all the way down to the bottom, it's best to do calls and puts, because these moves typically happen very quickly. As you can see, when it hits that 60 level, it moves back down to 50 over just a very short period, just a few trading sessions, it moves back down. So if you expect a quick and fast move, you want to use calls and puts. The other way to also look at double tops is that, it's another way to look at it is when it hits that top, you're basically saying, I don't think it's going to go above 60. And if that's the case, you can always sell a credit spread, and the credit spread will basically profit as long as the stock doesn't go above 60. So even if you don't think it's going to go back down to 52, you just simply think it's not going to go any higher, you can sell a credit spread and still be able to profit from this. Not as much as if you bought a put, and the stock moved lower, but if the stock simply just stays where it is, you're still able to profit when you sell a credit spread. So we'll go over a few examples of this in 1 second. I'll use some real live examples using some Canadian stocks to take a look at these types of strategies. Next, these are typically chart patterns. These are things like continuation patterns, and there's so many of them. There's flags, there's pennants, there's triangles, there's rectangles. There's so many of different ways, but they're all typically telling you one thing. What they're typically telling you is that a stock is kind of moving in one direction, and then it tends to consolidate for a period of time before it continues going in that same direction. That's why we call it a continuation pattern. Versus before, these are reversal patterns. These are telling you that the stock is going to reverse trend. So as you can see, the stock entered going into this double top, hit that double top, and then reverse lower. Versus continuation patterns are more where a stock rises, consolidates going sideways, usually a little lower before it rises higher again. Okay, so these types of strategies, again, have clear entry signals and clear exit signals, because you can usually measure the size of the flag or the pennant or whatever formation you're looking at, and you can use that to project out a specific target. So as you can see, the stock rallied about $10 entering this flagpole, or this flag, if you will. And then what it does is that once it exits this flag, that projects another $10 move higher. So what this means is that you have a clear entry and exit signal. So these are typically best used using debit spreads, because debit spreads allow you to really maximize the gain of a move higher, especially if that move doesn't happen over very quickly. A debit spread allows you to stay into a trade a little longer. It allows you to minimize your risk by reducing the cost of that trade, but still being able to take maximum profit of a specific move where you have a clear exit signal. And we'll show you an example of this in a second using some trades that I have set up in a minute. Next, what I want to cover is chart overlays. This is also another very popular form of technical analysis. If you've ever used moving averages or Bollinger Bands in your trading, please type yes into the chat window, because I know that this is a very, very popular trading strategy. However, I tend to see that it kind of gets misused sometimes. So I want to make sure we cover, how to use moving averages and Bollinger Bands, especially when we're talking about option strategies, okay? So when we're talking about moving averages and Bollinger Bands, these are what we call overlays, meaning it's an indicator that's drawn specifically over the chart. Now, the thing about moving averages and Bollinger Bands is that they give you clear entry signals. So for example, if the stock crosses above a moving average, that's usually considered a buy signal. If a stock crosses below the moving average, that's usually considered a sell signal, especially a longer period moving average, like a 100-day or 200-day moving average. These are fairly significant events, and they are generally considered as buy or sell signals. However, the thing about moving averages is that they have no clear exit signals. When a stock breaks above its 200-day moving average, there's no indication right then and there as to where it's going to go. Is it going to go up by 1%, 10%, 100%? It could be anywhere. So that's where usually buying calls and puts is one way to play this, because it really allows you to take advantage of a longer term move in one direction. However, the thing about moving averages is that you really don't have an idea as far as how much time it's going to take. That's why buying calls and puts sometimes is challenging, because do you buy a 1-month call or a 6-month call or a 1-year call? You really don't know when you're entering a signal on moving averages. So that's usually why sometimes I recommend using a credit spread, because if the stock goes above a 200-day moving average, you certainly expect that stock to continue moving higher, but you don't know if it's going to move 1% or 10%. And you don't know if it's going to happen over 1 week or 1 year. So that's why selling credit spreads simply just says that I don't think the stock's really going to go much further below the current price. I think it'll move higher, but I don't know how much higher. So selling a credit spread sometimes is a better way to play these types of moves. A Bollinger Band also. And also, one of the things that I've noticed is that a lot of people tend to use Bollinger Bands when it hits that upper Bollinger Band. You know, you basically expect the stock to fall back. If it hits that if it closes above that upper Bollinger Band, people expect it to come back. Also, another way to utilize credit spread. So every time it hits that upper Bollinger Band, you can sell a call credit spread. Every time it hits that lower or closes below that lower Bollinger Band, you can sell a put credit spread. So you can actually string a bunch of call credit spreads here, put credit spreads here, another put credit spread here as it reaches that bottom, and you can continue to string these along. So that's really a pretty good use case, in my opinion, for selling credit spreads if you like to use overlay strategies like moving averages and Bollinger Bands, because they don't give you clear exit signals. So I like to use credit spreads sometimes when I'm trading these types of strategies. Next, I want to cover chart indicators. Now, I know many of you use these type of oscillators. If you use them, please just type in which ones you like to use. You know, RSI, MACD, stochastics, William percent R. Feel free to throw your ideas in there. I'd like to see kind of what people use. I know a lot of people use these popular ones, but I've seen some pretty crazy ones out there as well. So it looks like most of you like to use MACD, a few RSIs, on balance volume. So it seems like the RSI MACD stochastics covers the broad range of what most people like to use, right? And this is really where I tend to see a lot of people kind of misuse options from this perspective. And the one thing that I really wanted to deploy is that the key theme of oscillators, and it really doesn't matter which one you use, right? So all the ones that you guys just threw out, RSI, MACD, on balance volume, these are all doing effectively the same thing. They're just different calculations or different methodologies to trying to achieve the same thing. And they're simply trying to tell you when a market is overbought or when a market is oversold, right? So if you use any of these oscillators, you see they tend to oscillate between two extremes. When it hits that upper extreme, that tells you that it's overbought. When it hits that lower extreme, that's telling you it's oversold. Now, the key thing about overbought and oversold is that it's a clear entry because it tells you exactly when something's overbought or when something's oversold, but it has a very unclear exit, because just because something's overbought does not mean that it's going to go to a certain price. And it can become overbought even if the stock doesn't move significantly higher, as long as there's enough time that passes. And that's one of the things about all of these oscillators, that there's a look back period. And as long as you exceed that look back period, the stock doesn't necessarily have to move very much in one direction in order to be overbought or oversold again. So that's really why the only strategy that really makes sense if you're using oscillators, and I know many of you use, is actually credit spreads, not debit spreads or buying calls or puts. Because in this example here, I have, this is McDonald's. I know this is a US-based stock, but it's a stock that many people are familiar with. I have here where it's the stock kind of hit this overbought category, overbought signal, and when it was trading around $50. And as you can see, just because it's overbought does not mean that the stock is going to fall. It just simply means that perhaps the stock's not going to continue going much higher. As you can see, it really spent quite a bit of time going sideways, about a month, before it became overbought again at around 51 or 52. So just a couple of dollars higher, and it was overbought again. And again, that doesn't mean that the stock's going to drop down to 48 or 46. It just simply means that it's unlikely going to continue going higher. So that's why selling credit spreads is a better strategy here. So when it hits 50, you might sell a credit spread in the 51, 52 range, basically saying, I don't think it's going to go much higher. Same thing here. When it gets oversold again, you sell another credit spread, maybe around 53, 54, saying, I don't think it's going to go much higher. When it hits that overbought again, you do the same thing. You might sell a 55 credit spread. And as you can see, as the stock trades sideways, even though it's overbought does not necessarily mean that it has to fall back down. And I think that's one of the key things that is sometimes misused with some of these oscillators, is that a lot of people feel that when it's overbought, oh, I got to short the stock, or if it's oversold, I got to buy the stock. And that's the key thing, is that just because it's overbought does not mean that it's going to move in the opposite direction. It's just simply saying that it's unlikely to continue moving in that direction that it currently was in. Granted, here was an example where when it did get overbought, it did sell off. But as you can see, there's plenty of examples where the oscillators, just because it's overbought, does not mean the stock moves lower. So that's why, again, when you use these types of indicators, I recommend that you consider taking a look at credit spreads versus debit spreads, or buying calls or puts, because overbought or oversold does not necessarily mean the stock's going to reverse, okay? It simply means that the stock is unlikely going to continue going higher if it's overbought, or it's unlikely going to continue going lower if it's oversold. So credit spreads are a much better way to play oscillators versus other types of strategies. This is just another example. This is using William percent R, which is, again, similar type strategy, a similar type indicator to all the other ones that you guys said that you use. So as you can see, when it's overbought, that doesn't necessarily mean that the stock's going to move lower. When it's oversold, doesn't necessarily mean that it's going to move higher. But you certainly can use these as buy and sell signals. But like I said, you have a relatively unclear exit. Just because you have one of these buy or sell signals, there's no indication necessarily as to how far the stock's going to move in one direction or another. Again, that's why I always advocate consider using credit spreads, which really allow you to take advantage. As long as the stock doesn't move much lower when it's oversold and doesn't move much higher when it's overbought, you can have much higher winners when you're using these types of credit spreads versus if you're trying to buy a call or a put. Lastly, market analysis. This is all. Now, this also covers a very wide umbrella, and this does not, by any means, show you an exhaustive list of market analysis. But things like relative strength, understanding how strong a stock is compared to other stocks in the market, is an important piece of technical analysis to understand. Not, if you're looking at two different stocks and they're both kind of bullish, how do you know one's more bullish than the other? Relative strength is one of the ways that you can analyze this. The other thing you can look at is things like a net 52-week highs. How many stocks have hit new 52-week highs versus new 52-week lows? Is that number of stocks at its all-time highs? These are all different types of things that you can use to look at the overall market. Lastly, intermarket analysis, very, very important piece of technical analysis. And the great thing, again, about technical analysis is that you can look at a chart of stocks, currencies, bonds, interest rates, all different types of things that have an effect on the stocks and the markets that you're trading. So it does make sense to keep a tab on what's currently going on in other markets, because it will help you make better decisions when you're trading stocks. So that's one of the reasons why I highly recommend people to at least learn the basics of technical analysis, so that you can read the charts of other assets that correlate to the stocks that you're currently trading. But however, I do want to point out that these forms of market analysis should be used as confirmations, not signals. So things like relative strength, just because the stock has relative strength does not mean that you should buy that stock. But if you're bullish on a stock and you see that it has strong relative strength, that can be used to confirm your buy signal. Or if you see that net 52-week highs are at all-time highs, that's just a confirmation that stocks in general are moving higher. That's a confirmation for for your bullish move. Or if, let's say, you're looking at intermarket analysis, meaning you're looking at other sectors, or if you're looking at the whole sector or the whole market as a whole and it's moving higher, that's, again, a confirmation for perhaps your bullish view on a specific stock, but you shouldn't use that as a signal itself. You should only use those as confirmation signals. Lastly, the best thing about intermarket analysis is really looking at a top-down approach, meaning not just looking at a specific stock, because when you're just looking at a specific stock, you're only getting a small view of the markets. You want to keep an eye out on the broader markets. How is the market doing? Is it bullish or bearish? Technical analysis is one way that you can kind of gather that information. How is the sector doing? So if you're looking at a banking stock, how's the bank sector doing? Very important to have a view on that before you buy or sell some of those bank stocks. Lastly, then you want to look at some of those, if you're looking at that bank stock, is it bullish or bearish, using your different forms of technical analysis. So when you're using a top-down approach, you're really allowing everything to line up in your favor. So if the stock is bullish and the sector is bullish and the market is bullish, you have a higher probability of that trade working out than if, let's say, you're trying to trade a bullish stock when the banking stock are bearish and the markets are bearish. So just keep those things in mind. And that's one of the key things about technical analysis, that it really allows you to keep track of these different things very quickly by just looking at a chart without having to do a lot of reading on looking at research and news and all that stuff. Just looking at a chart allows you to quickly gather this type of information. That's really why I like to use technical analysis in my trading. So with that, what I want to do is actually pull up OptionsPlay. This is the free tool that you guys all have access to through the TMX. I highly recommend you to use it. And what I want to show you guys is some examples that I have here today of different forms of analysis that I've kind of looked at. And I want to give you some examples and show you how I would utilize this tool to help me quickly find some strategies to trade based on the technical analysis that I see. So this tool, again, for those of you that are new, welcome. It's a free tool available to you through the TMX. You can sign up at tmx.optionsplay.com. I'll include the links in the slides after we're done. So if you don't have access to it, please make sure you download the slides and see how to get access to this tool. The tool itself is divided into 3 sections. We have trade ideas and watch lists here on the left. We have our security analysis panel here in the middle, and we have trading and income here on the right. Today, we're going to be focused on the on the trading tab. This is designed to give you instant strategies for trading. This is how we're going to set up our debit and credit spreads and everything to show you how to trade them. But for those of you that are looking for strategies like cover calls and short puts, you can utilize this tool to allow you to quickly help you decide where are optimal starting points for cover calls and short puts. You can utilize this tool for that. But today, we're going to focus our time on trading. So today, I'm looking at Enbridge. Please keep in mind that this is simply for educational purposes. This is by no means a solicitation to trade Enbridge. I'm just using this as an example to show you guys how you could potentially use OptionsPlay to quickly find an option strategy based on some of the technical analysis that we went over here today. So I looked at Enbridge, and as you can see, it really formed a bit of a triangle or a rectangle here over the last few months, from about early May to about late June. As you can see, it kind of consolidated here between 43, 39, and 43. So fairly tight range, as you can see. It hit that 43, came back down, hit that 43, came back down, and eventually kind of had this big break above this 43 level and really broke above to this 46 level. So this is the type of breakaways that we typically see on the stocks, and what we're expecting with these types of breakaways, usually see a bit of consolidation after a breakaway, but the idea is that we think that this stock's going to continue its trend going higher. So for this, there's a few different ways you can play this. You can either see this as a continuation higher where you really don't have a clear target. You can use previous resistance lines as their target. So as you can see, this stock kind of really had this bottoming formation for quite some time. So all the way from February to June, it kind of was below 44, 45, had almost like an inverted head and shoulders here if you want to look at a longer term chart, and it finally broke higher. And I think it's I think for my eye, it's $50 resistance level, which is where it was back in January, is a potential target here. So there's really quite a few ways you can play this. In my opinion, you can either buy a call because you think it's going to continue moving higher, but you don't have a clear directional view, or you think that it's going to hit 50 and you don't think it's going to go much higher. So you really have the choice of maybe trading either a call here because you want that unlimited upside, or you can trade this call spread or debit spread here on the right. So these tools are designed to provide you with these starting points without having to pull up an option chain. So how many of you have used an option chain like this before? If you have, type yes into the chat window, where you have a list of every single call or put listed by expiration strike price, right? And this is useful to get a feel for what are all the different options you can trade. But when it comes to actually selecting which one you want to trade, this sometimes can get quite overwhelming. Which expiration do you choose? Which strategies do you choose? Which strike do you choose? These are all different types of things that, it's really kind of an educated guess at best as to which one you start off with. And what you end up finding is that sometimes you choose one and then you decide after doing some analytics that it's not the right one. So you come back to this page and you select another one, and maybe that's not the right one. So you go back to this page. So you just end up doing a lot of back and forth. So what we wanted to do was create starting points for you that made sense for most people. So if you're bullish on Enbridge, you can click on I'm bullish and we'll present to you 3 bullish strategies. But for whatever example, maybe you're bearish on Enbridge, you can click on I'm bearish and we'll present to you 3 bearish strategies. So you can short the stock, you can buy a put or a put spread. And if you're bullish, we'll show you buying the stock, buying a call, and buying a call spread. And what this does, it allows you to compare different strategies, because when you're on a chains, you can only compare one strategy to the same strategy. You can only compare buying a call to another call or a put to another put. You can't compare a call to a spread. You can't compare a debit spread to a credit spread. This really allows you to be flexible in comparing different strategies, because typically you don't know what strategy you want to trade until you've analyzed it. This tool is designed to provide you with the starting points for the 3 most popular strategies. So if you're bullish on Enbridge, you will either buy the stock, buy a call, or buy a call spread. These are the 3 most popular strategies. So let's first take a look at those 3 strategies. So Enbridge is trading at $46.95. Like I said, I think $50 is a pretty decent target for this stock, considering it recently broke out from a 5-month kind of bottoming formation or inverse head and shoulders. So now it finally broke out and it's consolidating for a few days. I think that it's a pretty solid analysis to think that this thing could continue moving up to $50. So let's say what happens if I think the stock's going to move up to $50. So this is where our P&L simulator, a lot of people, when I start talking about the Greeks, people ask me, where do I find the Greeks? How do I calculate the Greeks? We do all of that work for you. You don't have to know how to do any of that work. Our P&L simulator tells you exactly what your expected profit and loss is, so that you don't have to calculate or approximate these things using back of the envelope calculations. This tells you if the stock goes to $50, exactly what your expected return is. So if you bought the stock, you make a 6.5% return. If you bought this call, which costs you $161 instead of $4,695 to buy 100 shares of the stock, you make a 148% return. So significantly higher return if you had bought the call versus buying the stock. But if you had bought this spread here on the right, you make 166% return because it only costs you $150. And this is, again, what I was saying in the very beginning. When you buy a call or a put, your risk is limited, because whatever you pay for that call or a put or that spread, your absolute risk is limited to what you've paid. So if you buy the stock, your risk is $4,600. If you buy this call, your risk is only $161. If you buy the spread, it's only $150. So even lower risk. So no matter what, you're risking less money. So, and what that means is by lowering the amount of capital that you're outlaying to start with, when the trade goes in your favor, you make a higher return. That's why this has the highest return here of these 3 strategies. Conversely, like I said, sometimes we're wrong, right? Technical analysis is not a crystal ball. Maybe Enbridge falls back down to this 43, 44 level because, it just simply breaks out and it doesn't come back, and it comes back down. As you can see, if it comes back down, if I had bought 100 shares of the stock, I lose $295, 6% return. If I bought this call, I actually lose less, only $161, because my losses are limited to what I've paid for that call. and the strategy on the right, I actually lose the least amount of money. So even though if this is right, I make the most profit. However, if I'm wrong, I actually risk the least amount of money here on the strategy. That's why the strategy here on the right has the highest options play score, because it's looking at the true risk reward of this strategy across both if you're right and if you're wrong, meaning risk and reward, and showing you, quantifying what your risk reward looks like. So this allows you to really compare different strategies and really quantify what are my expected profits, what are my expected losses, so that I quickly decide which one's best suited for me. So in this particular strategy, in this specific example, if let's say you decide that you want to trade this vertical here on the right, you can hit the trade button, and what we do is we provide what's called a strategy checklist. This is checking for a few different things. So if you're brand new to options trading, and please type new if you've never traded options before. If you have traded options before, type yes. I just want to get a feel for how many of you guys are new to this type of strategy, how many of you have been trading for a while. So it looks like most of you are yes, one or two of you are new, meaning you're new to options trading. So especially if you're brand new, the strategy checklist is designed so that you understand your risks before you place your trade, such as checking if you're trading with the trend of the stock, trading with the trend of the market, checking the options play score to see how your risk reward ratio on the trade is. We check for earnings, something that varies. We see a lot of beginners tend to overlook when they're trading. And lastly, we look at spread and liquidity. So these are all the key things that you want to look out for before you start getting trading. So, quite a few of you actually answered that you're new to options trading. Great. I'm welcoming you guys to options trading. I hope this webinar kind of helps inspire you to start taking a look at options trading. But this is all designed to help provide you with that guidance. And then once you're ready, it tells you exactly how to enter these orders into your broker's platform so that you have everything you need in order to start trading these strategies, okay? So let me go through one more example here before we kind of open this up for Q&A. I know I'm running a little over on time here, but I do want to give you guys one more example here. I was looking at Bank of Nova Scotia, banking stock, very popular sector in the Canadian markets. And what I noticed about Bank of Nova Scotia is you can see it's got a technical score of 4, which is telling me this is relatively weak stock. The 1 month and 6 month trends are bearish, telling me this is kind of a stock that's not only weak but continuing to weaken. And what I noticed that it's really kind of broken down. It broke down below this 80 support level, broke down, had this huge move lower, came back, kind of bounced a little higher off the 75 level here, bounced a little higher here, came back, bounced a little higher, tried to make a move higher, but couldn't, and just came back down. And finally really just broke below the 75 level. And ever since it broke below that level, it's kind of recovered a little bit. And these are the types of recoveries or rallies, these small rallies that provide potential entries for a move lower. You generally don't want to short a stock on its absolute low. You usually want to wait for some kind of check back, some kind of pullback to enter for a short. So here's an idea that I have. Again, I'm not saying that this is right, and I'm not saying that this is a solicitation for you to trade Bank of Nova Scotia. I'm just giving you insight into what I'm seeing in this stock. This is a weak stock. It's breaking down. And after it broke down below that support level, it came back a little bit higher, and I really see this as a potential opportunity to short. So here's what I have. Like I said, this is a stock near its 52-week low, so there really isn't much of a reference point. As you can see, it's a stock that's kind of continue moving lower. So the fact that it kind of broke below, and I think it's going to move much lower, I don't have any idea as far as where it's going to go. So I do think that maybe buying a put is one option that you can use. It allows you to basically say that I think the stock could really break down. So if you get one of these big moves down like you have here, that's really going to be able to take advantage of a long put. So what I'm going to look at is maybe buying a put. And what I'll also do is I'll take a look at a different strategy. I talked about using credit spreads, right? So let's take a look at selling a credit spread. And a credit spread is very simple. It's simply saying that I don't think the stock's going to go much higher, especially based on the fact that it's a relatively weak stock. It's got bearish trends. The fact that it rallied a little bit back to the 75 level is for me, I feel that this has hit some kind of small resistance level, and I don't think it's going to go much higher above 76. So what I can do is I can maybe sell a 76, buy back a 78 call, collect some premium in order to do that. And as long as the stock stays where it is, I collect my money. So let's take a look at this scenario, right? So I have three strategies here. I have the credit spread. This is for those of you that simply think that the stock's not going to go much higher, but you don't think it's going to go much lower. You just simply think it's maybe stay around here or move a little lower. You want to maybe consider selling a credit spread. For those of you that believe that this thing's going to make a big move lower, you should consider buying a put. And for those of you, and just for argument's sake, let's put the put spread next to it just to compare and see what the different outcomes look like. So like I said, the first scenario where the stock kind of stays where it is, it doesn't really move anywhere, what happens? So here, as I can see, I'm going to say what happens if Nova Scotia stays exactly at 75.18 between now and expiration, which is roughly about a month and a half away. Here, as you can see, if I had bought this put, I'd lose 43%. If I bought the spread, I'd lose 29%. If I traded this credit spread, I'd make 100% return. I keep the $52 credit that I received by selling this credit spread, and I keep all of that even if the stock stays exactly where it is. So even the stock moves a little bit higher, as you can see, as long as the stock stays below 76, I get to keep my $52 profit versus my strategies here will actually lose 100% of it. So even if the stock moves a little bit higher to 76, I'm still going to be able to be profitable here on the credit spread, basically saying I don't think the stock's going to move significantly higher. If the stock does move significantly higher, that's when I have substantial losses on this credit spread. So the credit spread, as you can see, I can lose substantially more than what I collect in premium. So that's one of the adverse effects of credit spreads, is that you do make money in most scenarios, but in the one scenario when the stock significantly moves against you, you do risk more money. Conversely, however, when you buy a call or a put or a put spread, you're completely limited to what you've paid on that credit trade. So if you paid 144, your max loss is 144. So now let's say what happens if I think the stock's going to go down to 73, maybe 72, and I really think that, in my opinion, that could happen because it's a weak stock to have bearish trends. It could easily break down. So here, as you can see, when you trade this credit spread, you still make that same $52, but that's all you can make. No matter where the stock goes, the most you can collect is that premium that you've collected on the credit. But if you bought this put, you can make 108% return or $156 profit on your 144 invested. Or if you bought this put spread, you make 158% return or $184 profit on the 116 that you've invested. So again, this really kind of depends on where you think the stock's going to go. Most of the time, you're going to see that this put vertical is going to give you better returns than this put, unless the stock really takes off. So as you can see, if the stock really breaks down to $70, so a pretty big move, about roughly a 10% move to the downside over the next few days, next few weeks. As you can see, that's really when the put starts to shine. You make a 308% return if the stock really breaks down. So this is really where, if you think the stock's going to make a quick, fast move and you don't really have a real target on it, you just think that it can move significantly, buying a call or put really allows you to take advantage of that. But regardless of what your views are, that's really the goal of what I'm trying to show you here today. The P&L simulator allows you to be self-sufficient in your analysis, looking at different option strategies and definitively saying which strategy is best suited for you. You don't need me to walk you through it. You don't need someone else's help. You can use this P&L simulator to create all different scenarios and definitively say which strategy gives me the best return so that I can trade these, and also at the same time look at what happens if I'm wrong. Am I okay with the losses that I would expect if the stock goes against me? What happens if the stock goes up to $79? What are my losses? Am I okay with that? Am I okay with losing $148 when my max reward is only $52? Maybe you're not okay with that. So in that case, maybe you might want to trade this vertical instead. So this is really, this P&L simulator allows you to be able to analyze option strategies without having to know how to calculate Greeks and know how to do all of those complex back of the envelope math problems. This allows you to definitively say exactly which strategy is best suited for you. And I hope you guys find this useful, even if you don't use technical analysis, even if you just use other forms of analysis, you can still utilize this tool, set up all different types of trades, and see exactly what your expected profit and loss is for each individual strategy. So with that, what I want to do is I want to open this up for Q&A. For those of you that have any questions, please type them into the chat window. I'd be happy to answer as many questions as I possibly have time for. Uh, I have a question here. What short strategies do you use Fibonacci charts to calculate where things may retrace to? So Fibonacci's, oh, what short strategies do you use? What short strategies do you use Fibonacci charts to calculate where things may retrace to? So, Fibonacci, in my opinion, is a fairly esoteric. With short strategies, do you use Fibonacci charts to calculate where things may retrace to? You can. So all of these different techniques is designed to provide some type of targets, right? And Fibonacci certainly is one way to do that. I shy away from using Fibonacci just because it's so subjective, because it's all contingent upon where you start and where you end your charts. That determines all the levels in between it. And I find that just a little too subjective. And what I tend to find is people just kind of move around their start and entry points until they find the levels that they want. So I'm personally just not a big fan of that, but you can certainly use them to help you determine targets. It's a very popular tool being used. My best advice for you if you're using Fibonacci levels is that you should use the same consistent approach to Fibonacci, meaning if you're going to use candlesticks, right? A lot of times you can draw Fibonacci's using the bodies of the candles, or you can redraw the Fibonacci's using the wicks of the candles, and they produce very different results. So it's less important as to how you use it, but more importantly is how consistently you apply your Fibonacci levels to your trading. So, and sometimes you end up applying Fibonacci's to a monthly chart, sometimes you apply it to a daily chart. Just be consistent with how you do your Fibonacci retracements, in my opinion. That's the best advice that I have for you. I have another question here asking how to use this tool for the US markets. Great question. So in the links that I'll send you today in the slides, I'll include both the access to the free Canadian version for those of you that don't have access to it. We'll also send you a link to access OptionsPlay for the US markets. You have a free 30-day trial to the US markets. It's the exact same platform I showed you guys here today with US equities. You guys get a free 30-day trial and a discounted version to the US trading if you were interested in subscribing to that. What if you want a longer expiration? Great question, Steve. So if you want to trade a longer dated expiration, so if let's say you're looking at this Bank of Nova Scotia example here, and you want to trade a longer dated option, you can always click on modify for any strategy, and you can use the strategy drop down to select a different expiration, or you can simply just use the expiration slider. You can move it out one expiration or in one expiration simply by clicking on the slider. And this is really useful when you're trading multi-legs, because you don't want to constantly have to move all the different legs each individually. You can just click on once and it'll move all the expirations in one, or even if you want to move all the strikes up one or down one, you can use these arrows. This is all designed to help you play around with all the different strategies. We call it OptionsPlay specifically for this reason, because when you're using this types of page, I really don't consider playing around, trying all the different strikes and expirations playing around. We really wanted to facilitate the concept of trying out different strikes, trying out different widths, trying out different strategies side by side, putting them side by side and comparing them and seeing which one's actually best. At the end of the day, every single person has a different view and target of where they think stock's going to go. So there's no such thing as best strategy. It really depends on what your views are. So this tool really allows you to construct all different types of strategies and play around with them. But, this is all designed to give you that starting point. So regardless of what your views are, you can click on I'm bullish and be presented with 3 good starting points for a bullish view, or 3 bearish starting points, regardless of what your views on any given stock or ETF. Bruce, thank you very much. I really hope you guys have found this useful. Any other questions regarding, any of the things that I went over here today? Like I said, this webinar is recorded. I covered a lot of things. I don't expect anyone to have memorized everything. So please make sure that you take a look at the recording that we'll send out. That'll go out in about half an hour. It'll also include the slides, so make sure you download those slides as well. So for those of you that are looking for the sign-up links for this free tool for Canadian equities, and for those of you looking for the US version of OptionsPlay, I'll include those links in those slides. Any other questions regarding any of the things that we went over? How can we view more stocks since only a few are available? Every single stock that's tradable is available. Just type them in. Is there a symbol that you were looking at that you wanted to look at? You just type in whatever stock that you want to look at. So IBM is on the US market, so you can enter that into the US version of OptionsPlay. So the free version only covers Canadian equities. It's subsidized by the Toronto Montreal Exchange, so that you have access to OptionsPlay completely free of charge with all Canadian equities. On the US side, we will give you a free 30-day trial so you can test things out, and afterwards we do give you a discounted version if you have a Canadian version of OptionsPlay. So if you want IBM, that's something that we can certainly facilitate. If you're looking for Air Canada, here you just type it into the chat, into the symbol widget, and you can type in any Canadian equities. Any more questions? Raymond, thank you very much. Thank you very much for all the thanks. Yeah, atd.b should be able. Yep, you should be able to type all that in. My profile says Canadian OptionsPlay expires in September. So that's something that we will renew, because we've recently just renewed the contract with TMX. So you will get another free year of OptionsPlay for Canadian stocks. Any other questions? If not, I just want to thank everyone for taking the time out this afternoon. I hope you guys have found this useful. We really want to continue doing these webinars for you guys for your educational purposes. If you can send me, I know you have a question about that, please send me an email at info@optionsplay.com. I'm happy to answer your question regarding that. It's something we provide on the US side, but we can't provide on the Canadian side. So thank you again, everyone, for those of you that have attended here today. My email is info@optionsplay.com. So if you have any questions or comments or feedback, please send them and we'll be able to help you out with those. So thanks everyone for attending. I hope you guys have a great afternoon. Look out for the email that will have the recording and the slides afterwards. Have a great afternoon.